Welcome to the deep dive. We've got a really interesting set of sources you sent over, all focused on the Thai stock market, the SET index, and its current outlook.
Yeah, quite a discussion here, featuring different experts, some looking at technicals, charts, others digging into market psychology, and then the fundamentals, the policy side of things.
Exactly. And our mission today is to unpack all that for you. Pull out the key insights these experts are flagging, the warnings, maybe some potential opportunities they see. The idea is to get you up to speed quickly on this, well, complex picture.
It definitely seems complex. One source even described the market right now as like a dizzy boxer.
A dizzy boxer. Okay, that paints a picture. Wobbly, uncertain.
Right. Kind of disoriented. So understanding why these different experts see it that way, that's what we're diving into.
Okay, let's do it. How about we start with the technical view, the charts, the indicators. One expert in the source material really leans into this.
And they put a lot of weight on specific moving averages, the 75-day and the 89-day. They use pretty strong language, calling them almost life or death lines for the market's trend.
Life or death. Wow. Okay, so where is the SET index right now compared to those lines?
Well, that's the thing. It's trading below both of them currently.
Oh.
Yeah, and according to this view, historically, when the index slips below these lines, well, it's been a major warning sign, often led to significant drops. So yeah, being below them is a clear negative signal for this analyst.
Okay, so that's one big red flag. Are there other technical signals they're pointing to?
There are. They also mentioned the MCD indicator,
Okay.
but specifically on a quarterly time frame. And the really concerning part they flagged, the quarterly MCD is below the zero line right now.
And that's significant because?
Because, as they point out, the last time it was like this was during the Tom Yum Kung crisis.
Seriously, back to 97 levels on that indicator.
Yeah. So, that's flagged as a pretty severe longer-term downturn signal from that particular technical perspective.
Wow. Okay, that definitely adds some weight. So we saw the market bounce a bit recently off that 1,010.50 level. Does this technical view see that as a positive sign, a turnaround?
Not really, no. Not yet anyway. From this technical standpoint, it's just seen as a rebound, a temporary bounce within a larger downtrend.
Right.
The overall technical setup with the index below those key moving averages and that quarterly MACD signal, it hasn't really changed enough to say, okay, we're starting a new uptrend.
So for someone watching these charts, what would need to happen? What levels are key for maybe changing this bearish picture?
Well, they highlighted watching the 1220 level. Seems that's a significant point. Maybe resistance, maybe somewhere the market needs to prove it can respect.
Okay.
But for a real shift, something more definitive suggesting things are actually improving.
Yeah.
They say the market needs to convincingly break and hold above 1280.
Break and hold 1280.
Got it. And they also made the point that upward moves usually take time and effort, It's not like the sharp, quick drops. Recoveries tend to grind higher.
That makes sense. Did they mention anything else about trading in this environment?
Yeah, they did touch on the difficulty of short-term trading. Part of it, they suggested, is down to the rise of robot trading, HFTs. Makes it harder for human traders to compete on those very short time frames. It's just become more sophisticated, more challenging.
Okay, so putting it all together from the technical side, what's the strategy implication? What's the advice?
Based on this analysis and the source, it's pretty much wait and see. They specifically advise holding cash right now.
Just sit on the sidelines.
Pretty much. They also note that liquidity is low, which makes it tough for big players to move money around without really affecting prices. So that forces them to either be very selective about individual stocks or try to navigate these tricky short-term trades. It's just not an environment for broad, confident buying, technically speaking.
Okay. Really clear picture from the charts. Very cautious. Let's switch gears now completely. What about the human side? Market psychology. The sources also have an expert talking about this, mentioning a benefit theory.
Yes, the benefit theory. The core idea, as it's explained, is that the biggest opportunities, the really huge market gains, they tend to happen when almost everyone is absolutely terrified.
Right. Peak fear.
Exactly. When hope is gone, people are capitulating, selling everything just to get out. That's when a small group of buyers can step in and get things really cheap. Maximum pessimism equals maximum opportunity, basically.
Okay, the classic contrarian idea. Buy when there's blood in the streets. So what does this expert say about the current psychology in the Thai market? Is it like that, or people capitulating?
Well, this is where it gets really interesting and maybe a bit different this time. According to this expert, unlike maybe the COVID crash or the subprime crisis, a lot of investors remember those events.
Wow.
They remember that eventually the market came back. They learned perhaps that big downturns can be buying opportunities later on.
So they're not panicking in the same way.
Apparently not to the same extent. So even if they're fearful now and the news isn't great, they're not necessarily dumping everything. Many are holding on, maybe gritting their teeth, hoping for that eventual recovery. The psychology is different because of those past lessons.
Okay, so people learned something from history. But how does that change the market dynamics now? This widespread hope, this reluctance to sell everything. What does that mean for potential upside?
Well, here's the counterintuitive twist they highlight. That very hope, that lack of full-scale panic selling, it actually limits the potential upside for the market as a whole.
Limits the upside.
How? Because you don't get that deep, forced selling that creates extreme undervaluation and washes everyone out. So this expert suggests the upper limit for a rally might be somewhere around, say, 1,300, maybe 1,400, but getting much beyond 1,400 for a major, sustained move seems unlikely from the psychological perspective. There just isn't enough fuel from forced selling.
Oh, okay. So hope limits the rally potential. What about the downside then? Does it limit that too?
Yes, and this is also really key. That same dynamic also limits the potential downside. Because people are already quite fearful, a lot of the bad news might already be priced in or expected.
Right.
There might not be that much more fear left in the tank to cause a complete collapse way below, say, the 1,000 level, at least not sustainably over the next year or two. It's like the pain threshold has been reached for many who are still holding.
So limited upside, limited downside.
Yeah.
Stuck in the middle.
Yeah.
What does that imply for market direction?
Exactly. From this psychological viewpoint, the most likely path for the market is sideways. The phrase they used was out to the side. Not a big up move, not a big down move, just sort of grinding sideways.
There was also an interesting point in the source about how people remember past crashes.
Oh yeah, that was quite insightful. The point was, people tend to forget how absolutely terrifying it felt living through a market crash in real time. They only remember the outcome that it eventually went back up. And in hindsight, that rebound seems obvious. Of course it recovered, but they forget the gut-wrenching fear. And because they forget the feeling, they don't truly learn the right lessons about navigating that kind of uncertainty. It's a kind of self-deception.
That rings true. And this expert also mentioned something about the market system itself, maybe AI.
Yes, they floated this idea that the market system now, maybe boosted by AI and sophisticated algorithms, is almost designed to, well, to read human behavior, to anticipate what investors will do.
Like it knows what we're thinking.
Kind of. The idea is it can capitalize on predictable patterns like everyone writing to buy when things look good or panic selling together. It feels, from this perspective, like the system is almost engineered to profit from those common human psychological biases.
It's a slightly unnerving thought. Given this view, limited upside, sideways movement, maybe a system gaming us, does the psychology expert suggest looking elsewhere?
They do. They explicitly suggest that for the next few years, maybe even 5 years, the really significant opportunities might actually lie outside the stock market entirely.
Interesting. What about other stock markets?
They touch on that too, suggesting even places like the U.S. market might have limited upside from here. But interestingly, they also note that the very high level of fear already present in the U.S. market could actually act as a buffer, potentially preventing a massive crash there. Fear itself becomes a stabilizing factor, paradoxically.
Wow. Okay, so the psychological view adds a whole different layer, explaining why there might be that technical hesitation. Yeah. Let's bring in the third perspective from our source material, now the one focused on fundamentals, but especially on the role of policy.
Right. And this expert makes a really central argument. They say the stock market isn't just investing in current GDP numbers or company earnings. It's primarily investing in policy.
Investing in policy. Explain that.
The idea is that investors are looking at the direction the government and central bank are setting. What's the plan? What's the vision? How will their actions likely impact the economy and companies down the road? That's what really drives long-term market confidence and direction, more so than just the latest economic data point.
Okay, that makes sense. Did they give examples?
Yes, they gave a couple of strong international examples. Germany, for instance. Its stock market hit all-time highs recently, even though its GDP growth was actually negative.
How did that work?
Well, this expert argues it was because the European Central Bank had a very clear, very supportive or dovish monetary policy. That gave investors confidence in ongoing economic support, regardless of the current weak numbers.
Okay, policy trumped GDP. What was the other example?
Argentina. Its market absolutely surged, like over 100% last year, even with all its ongoing financial troubles.
Right, huge problems there.
Exactly. But the surge was attributed to a new government coming in with clear, decisive, and pretty radical fiscal reforms aimed at tackling those long-standing issues. Again, it was the clear policy signal, the perceived decisive action that drove the market, not the current messy reality.
Powerful examples.
Yeah.
So how does this expert apply that policy lens to Thailand's current situation?
Well, this is where the critique comes in. They argue that Thailand right now lacks that crucial, clear, decisive policy signal. Yes, the central bank cut interest rates, but it's seen more as reactive cutting because things aren't great.
Not proactive.
Exact. Not seen as a strong signal that they're actively trying to boost growth or tackle issues like the strong Thai baht, which, hurts exports and tourism. And then on the government side, the source points to political complexities, maybe constraints, making it difficult to push through really bold, significant reforms. So policies might seem a bit half-hearted, or maybe they don't get fully implemented.
And the impact of that perceived lack of clear policy. What does this expert say it does to the market?
It creates a negative narrative, a story. The story becomes Thailand lacks prospects, or there's no clear future direction. And according to this view, that narrative, driven by the policy vacuum, is what erodes investor confidence, both local and international, and ultimately leads to selling pressure.
So it's about the story the policy tells or doesn't tell.
Precisely. This expert also critiques some specific market measures, like the uptick rule or controls on short selling and high-frequency trading. They argue these measures are kind of missing the point.
How so?
They suggest it's like blaming the tools, the market mechanisms for the downturn instead of addressing the root cause, which they see as the lack of confidence due to unclear policy. They argue things like short selling and HFT are actually generally healthy for liquidity in mature markets.
Okay, so if policy is the problem, what's the solution according to this expert? What's needed for a real recovery in the Thai market?
Simple, but maybe not easy. Clear policy signals need to emerge. Investors need to see concrete actions that show a decisive direction for the country, for the economy. It's about rebuilding confidence by presenting a believable, compelling vision for the future.
Makes sense. So given this policy uncertainty now, what kind of investment strategy does this viewpoint suggest for Thailand?
Well, if you are investing in Thailand right now, despite the overall negative narrative, they suggest looking for specific companies, maybe with low valuations, because market illiquidity and lack of confidence can create discounts.
Okay.
Focus on companies that seem resilient, adaptable, maybe ones positioned to benefit if or when policies do eventually change, even if the overall market story is still gloomy. The alternative strategy they mention is to look globally. Find opportunities and big trends that are less dependent on any single country's policy, like, AI, automation, robotics.
Right, global themes.
Or look for other countries that do have clear policies aimed at benefiting from new global shifts. They mention India, maybe some South American nations potentially gaining from things like tariff changes, countries with a clearer story.
Did this expert mention their own positioning?
They did briefly. Mentioned having moved money into Thailand previously, kind of hoping for political change and a rebound in valuations.
Okay.
But more recently, because those clear policy signals haven't really materialized as hoped, they've actually started shifting some funds back out again towards foreign markets.
That's telling. Is there a final concern from this policy perspective?
Yeah, a key worry they raised is more long-term. While the downside in the Thai market might be somewhat limited in the next year or two, the real risk is that if policies don't adapt to the changing global landscape, Thailand could risk becoming a long-term loser, meaning a protracted period of underperformance. They made the point that even fundamentally sound companies can see their stock prices hammered if the overall market confidence just keeps shrinking, what they call PE contraction. The whole market gets derated.
Okay. So we've got these three quite distinct viewpoints: technical, psychological, policy-driven. They all seem, well, pretty cautious about the Thai market right now, but for different reasons. How do we tie these together?
Well, even though they use different tools and language charts versus emotions versus government actions, you're right, they do seem to overlap quite a bit in their conclusions about where the Thai market is.
Yeah.
All three point towards this being a period of significant uncertainty, limited upside potential, at least in the near term, and facing some real challenges.
And it feels like they almost feed into each other,
Absolutely. You could almost see it like this. The technical signals the index below key averages, that weak quarterly EBSED, that's the symptom.
Yeah.
It shows the lack of buying conviction, the market weakness. The psychological analysis helps explain why that conviction is missing. It's this weird mix, right? People learned from the past, so they're not panic selling, but they're also fearful and maybe too hopeful to allow for that deep capitulation needed for a big rebound. So they hesitate.
Right, the hesitant holding pattern.
Exactly. And then the policy view offers a potential root cause for all of it. It argues that the fundamental lack of confidence, the negative narrative driving the technical weakness, and the hesitant psychology stems from the absence of clear, decisive policies that would give investors a reason to believe in a strong future direction.
Symptom, explanation, root cause.
Right.
That's a neat way to frame it. But it sounds like, despite all these concerns about the big picture, none of these experts are just saying, game over, nothing to see here.
Oh, definitely not. Even while highlighting the challenges for the overall market, they're all still looking for opportunities somewhere. Whether it's the technician waiting for specific chart signals to confirm before committing cash, or the fundamental analyst looking for those resilient, low-valuation companies, or maybe looking globally for clearer policy stories, the search for returns is still on. It just might require more patience, more selectivity, or looking in different places than just the broad set index right now.
So bringing this back to you, the listener, why does hearing all these different takes matter for you?
Well, I think it really highlights how complex market analysis is, right? There's rarely just one single answer. Hearing these different viewpoints gives you multiple lenses, multiple frameworks to understand what might be going on.
Helps you build a fuller picture.
Exactly. It underlines why patience can be important in times like these, why having a clear strategy based on your chosen approach matters, and maybe why being open to looking beyond your home market or usual hunting grounds might be necessary when things are challenging. It helps you process all the noise and hopefully form your own, more informed perspective.
Absolutely. So, wrapping up this deep dive based on your sources, the time market seems to be in a really complex spot. You've got technical red flags flying, a unique psychological state born from past experiences that's limiting both panic and strong conviction, and fundamental concerns tied pretty directly to policy uncertainty.
Yeah, and while that psychology might limit the immediate freefall, the path forward seems likely to require quite a bit of patience. Careful strategy is key, maybe focusing on specific niches rather than expecting the whole market to lift off anytime soon.
And maybe a final provocative thought for you to chew on, something that came up in the sources.
Yeah.
This idea that the market system itself, perhaps enhanced by sophisticated AI these days, might be getting incredibly good at anticipating, maybe even exploiting, our collective investor behavior and psychology.
The market reading our minds, or at least our patterns.
Right. How does thinking about that possibility that the game itself might be that sophisticated change how you approach your own investment decisions or how you interpret the market's moves? Something to definitely mull over.
Definitely food for thought.
Indeed.
Yeah.
Well, thank you for sending over these sources. It was a fascinating deep dive, gave us a lot to unpack.